right. Hi, everybody. How are you guys doing? How's your week? Does anybody have anything eventful they want to talk to us about? Anything unique happen in your world this week that we need to know about?
No.
That was quick.
No.
Well, I'll tell you guys something as you think surely something happened this week. Let me just give you guys time to think about it. I'll tell you about mine. So my son, the last child, he's 18 and he wants to buy his own property. So we've been going to different places in Baltimore to take a look at properties, and I'm tired. I'm like, I don't want to keep going. Like, can we put an offer already and be done? We put an offer on one, it was rejected. So what I did was I told him that rather than us going out, if we see the house and we like it, can we at least put an offer? And if they accept it, then we can go and see it.
Don't look.
So that's what we did. We put an offer. It was partially accepted. They wanted us to put our earnest money deposit with their title company. So we're like, okay, let's go out. No, Nancy, that's too quick. No congrats yet. Wait till you hear the full story. So, so we're like, okay, before we actually go and put the deposit, let's go and take a look at the property. We got to the property. I kid you not. I was literally so pissed off. I'm sorry, but I don't know how to explain this. It's like a three-bedroom property, and all three bedrooms are on the top floor. And are you ready for this? The bathroom, the only one bathroom that you have on the third floor, you have to get through two of the rooms to
Ah,
get to the bathroom.
oh my gosh.
I went oh I like we went back twice to look at the listing because there's no way you look at the listing and know like how did somebody conceive that it was okay to put a bathroom where you have to get through two bedrooms to get to the bathroom. So it's like you have to go into the first room, which is the master. Then you go from there to the second bedroom. Then you go from there into the bathroom all the way at the corner. I'm like, who does this?
Oh
Like, has
my
anybody
gosh.
ever had that kind of experience with a layout that's just absolutely ridiculous? So bottom line, we rescinded the offer. And Jonathan Ronlet is our realtor. He's kind of talking to us about maybe looking at doing rehabs. But for an 18-year-old trying to get his first property, he's at UMBC. So the goal was to buy the property and then rent it out to other students. I'm like, I don't know if we want to start getting into rehabs in Baltimore. So, oh, it's a railroad. Nancy, what does that mean, railroad apartment? I've never heard of that. I was trying to see, like, does anybody even know anything about this or whatever, or had such an
No.
experience?
I have not
My
personally.
first apartment was like that.
Are you
The only
serious?
bathroom was in the bedroom.
Wow.
Yeah, it was not good.
So Shirley, there 40 years ago, the same. There are New York City apartments like that. So what? I guess it has to be really a family. It's not something where if you're trying to rent out the separate rooms, that's not going to work. What you got to wake somebody up in the morning to tell them you're going to their bathroom?
It just walk. Whoever uses the bathroom the most gets the one closest to the bathroom. Whoever goes the
Oh my
most,
god!
you know.
It was just too. Like I was so mad. I was like, I drove out for this. Anyway, we rescinded the offer. So I said, oh, okay, I guess my plan of trying to be efficient is not going to work where I wanted to put an offer before going out to see the property. You definitely have to go out. You definitely, definitely have to go out. So now we're still back in the market. So anyway, anybody have any advice for Baltimore properties? Because this is like, we're looking near UMBC 21230 21229. Zip code, does anybody do anything in any of those areas?
No,
Mm-mm.
not at all.
Yeah. Okay. Okay. So that's a lesson learned. So today we're going to be talking about retirement planning. So retirement planning for all age groups, and I know that this is usually a very sensitive topic for a lot of people. So we just want to, I'll try to cover it as much as I can, but I encourage you, especially if you're in the wealth building program, if you have not already scheduled your wealth building plan meeting, please reach out to your team lead to get this meeting scheduled. Because that's where we really can talk to, everybody about what's going on with your retirement planning. So there are just several things that I wanted to bring up today. Um, for hold on, I'm trying to bring somebody in. Make co-host. I see Anthony Malone just joined us. Okay.
Hi,
Hi, Anthony. How are you?
I'm doing fantastic, doing great. Yeah.
Okay. So before we start, can you introduce yourself? Tell us a little bit about what you do, and then I'll get into the topic. And just feel free to chip in as
Okay.
I cover the topics.
Yes. Thank you for having me, Ms. Ebera. I'm actually a financial advisor with PFS Investments. I have been working with PFS Investment for the past 27 years, and I work with small businesses as well as individuals in terms of wealth management. Um, that's for short. Okay. Thanks.
All right. Thank you. Thank you. Thank you. All right. So one of the things that I want to talk about today is kind of like preparing for retirement, kind of like discussing like I'm not going to use a traditional approach. It's more of like the things that I've seen out there that people are talking about in terms of preparing for retirement. Because the focus is more of like for people when you start getting into your late 40s, 50s, some people might feel, oh, it's too late to really start preparing for retirement. But actually, you really have time to catch up. If you look at the age between 50 and 67, that's a whole 17 years where you can potentially catch up on retirement. Even if you're 55, that's 12 years that you have. Even if you're 60, that's 7 years. So never feel that it's too late to start on your retirement planning. So maybe you guys can post in the chat. Let me know, how are you feeling about retirement? Are you feeling excited? Are you ready? Or you're like, I'm not sure about all this. What do you think?
Anxiety, anxiety.
Yeah, a lot of anxiety. Yes.
Uh,
Never too early, never too late. That's good. Not ready yet. Thank you for being honest, Dennis. You and me both. We're like, we got to get these kids out of college, right? By the way, congratulations, Dennis. I saw that one of your sons graduated.
Yes, thank you,
Congratulations.
Aiden. Thank you.
Congratulations. One
Appreciate it.
year to go, Laurie. Yes. So we have different viewpoints here about retirement. Jerry and Regina retired and loving it. See, we need to talk to Jerry and Regina what they're doing. I want to be like them when I grow up. Anne Marie would like to retire tomorrow. Yes, our kids don't want to work. They just want to skip the working years and go straight to retirement. Somebody needs to explain that to me. So who else? Sonia feels ready but concerned about taxes. That's true. We will be ready for retirement in 2027. Congratulations. So Randolph is retired. Good, 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 good. And let's see, feeling pretty good where I'm at and still working, building small business. And then need to a drawdown plan. Okay, good. Thank you for sharing. Leslie, biggest issue for me, while in retirement is health insurance. Exactly. That's a huge issue that's coming up. Eric is retired, ready, hope to have a good Roth conversion strategy. So thank you, thank you, thank you. We will cover as many of these as we can as we go along. So the first thing that I wanted to point out is that it's not too late to start taking advantage of your retirement and start planning for retirement. Even if you were not ready, even if you didn't contribute anything, even if you feel a level of anxiety, you can start today to start planning for your retirement. So I'm going to talk about 5 different strategies that you can use. And then as we're discussing these things, then I would go over some of the things that have already been put in the chat. Okay? So the first thing is about the catch-up contribution. I'm not sure how many of you know, but you are able to put money into the retirement account, to a 401k, and you are able to do a catch-up. Okay? Actually, let me share my screen so you guys can see it. Okay. So here, you are able to do a catch-up contribution. After you're 50. So if you're in a 401k plan, in addition to the regular contribution, you can do an additional catch-up contribution of $7,500. So that's an extra catch-up. In addition, you can do a super catch-up between the ages of 60 and 63 years old. So that's an additional $11,500 that you can contribute to the 401k plan. So if you're between the ages of 60 and 63 right now, and you feel like maybe you're not ready or you need to do more, you can do super catch-up contributions. So those super catch-up contributions is it's $11,500. It keeps going up for inflation. In addition to your regular catch-up contribution of $7,500. So yeah, right there, you have almost $20,000 additional that you can put into your retirement account. And so you're kind of doing it aggressively. Think about it. Kids are getting out of school. They're going on their own. We need to kick them out. I'm sorry. Let me stop. We love our kids, but they got to go so we can build up for retirement. They're graduated. They're getting married. They're leaving the house. So the expenses that you have, when they were younger are no longer there. Instead of increasing your lifestyle, you can put a good chunk of that money away into retirement in order to catch up. So you want to check with your job to see whether you have that ability to do the catch-up contribution. So I'll pause here and see, does anybody have any questions on that? Or Anthony, do you have a contribution to that before we move on?
I have a question.
Okay.
Yes. Go ahead.
Oh,
is that
the catch-up?
Tiffany?
Yes, ma'am. Is it catch-up for just the 401k, or can you catch up with a Roth IRA also?
There is a catch-up for the Roth and traditional IRA, but the limits are a lot low. Like it's like $1,000 that you can do catch-up. You can't do the super catch-up. The super catch-up is for a 401k.
Oh, okay. All right.
Yeah.
What I wanted to also say apart from the catch-up, I believe you also have a choice to do, if your company allows it, the Roth IRA, feature to it. If your 401k has a Roth IRA feature where you can put some, after-tax dollars into a Roth, which would be tax-free later.
Yeah, and so let's discuss the Roth IRA strategy right now. So let me tell you what I do with our clients who do want to do the Roth. We do an analysis based off of your AGI to see what the sweet spot is for you to do a Roth IRA conversion. So usually we're looking at what your AGI is. If you're approaching retirement or if you're going to retire, does it make sense to wait and do the Roth IRA conversion in the later years when you have less income? So we had 2 clients last year who wanted to put money away into their Roth IRA account. They wanted to do a conversion. So the strategy that we used was we did an analysis. And in the analysis, we found out that one person would be paying a lot of taxes because they're still working. And so we told them it's better for them to wait 2 years after they retire, then they can do the Roth IRA conversion. The other client, they were able to actually do more Roth IRA conversion because they had all these losses that what we call wasted deductions, losses that they were not going to be able to use. So by doing the Roth IRA conversion, they were now able to utilize some of these losses. So per se, they did not pay any taxes on the Roth IRA conversion because now they had losses that they were able to use to absorb the amount of Roth IRA. So I think they did almost $50,000 or $60,000 Roth IRA conversion and didn't pay any taxes because they had all these losses from real estate, from wasted deductions that was just going to go to waste. So also there's a way to think about when you want to contribute to your IRA or do a Roth conversion, make sure that you're doing the tax analysis to see whether or not it's a fit for where you are in terms of your AGI and in terms of your tax liability. All right, the next thing that we're looking at is paying off mortgage before retirement. So if you're approaching retirement, depending on when you bought your property, you might have a 30-year mortgage. But if you're able to go from a 30-year mortgage to a 15-year mortgage, if you pay one extra mortgage a year on a 30-year mortgage, you effectively reduce your mortgage period from 30 years to 22 years, right? So you could even, supercharge your retirement further by paying off your house faster. Because if you're able to have a fully paid off house at retirement, that significantly reduces your income that you need to live at retirement. And then you're not having to continue paying a mortgage into retirement. And then you can enter into retirement mortgage free. Does anybody have any questions on that strategy of paying off your mortgage before we move on?
Wow.
Okay, so because we're talking about housing, I also want to bring up this aspect of housing. We've had people who, because of whatever situation's going on, they decide that they want to go ahead and transfer the property to their children right now while they're living. You want to be very careful about that because if you waited until you pass for the kids to inherit the property, they get the property at a stepped up basis. They get the property at fair market value, including the rental properties, right? You don't want to transfer it to them right now because when you transfer it to them right now, they're getting it at your current basis. Whereas if you waited until you're passing for the children to get the property, they get the property at a stepped up basis, meaning if they wanted to sell or anything like that, they will not have taxes. And guess what? If you have all this depreciation that you would have had to recapture upon selling, when it goes to your children, that recapture goes away. So because we're talking about housing, I wanted to bring in that strategy in terms of how you get properties, into the hands of your kids. You can have it in your will. You can actually add them to the deed of the property. So you add them to the deed, but maybe they only own 1% or 0.1%, and you have 99%. So they have access, right? It's helping you to avoid probate. But in terms of the burdens and benefits of the property, you don't want them to get those properties until after your passing so that they're able to get it at fair market value. Okay, any questions on that before we move on?
Yes, hi Barry. I have a question regarding that. So you're saying that if we add them to the deed as a 1% owner, that can avoid probate?
Yes, because they're already on the deed. And if you have a document, maybe like a joint venture agreement or whatever, that says that automatically upon your passing, the 99% goes to them, you can avoid probate because there's nothing to transfer from you to them.
Oh, okay, okay. Another question now in regards to keeping the property in your name and then having it transfer over to your children's name at your death. Now, how does that come into play where as you're getting older and you may need like long-term care assistance? Would that be a problem that you're owning property in your own individual name or your, LLC?
Yeah, so that's a good question. So we do have some people that are dealing with that right now where there's a 5-year seasoning under which you can get any kind of care or whatever, and they will have to look at the assets that you own. So that's kind of like a judgment call that you have to make. Would it be better to transfer the properties to the children or maybe to a trust that it does so that those assets don't count towards your assets? There's 5 years that you have to wait from the time of transfer where it doesn't count, whether you're doing the Medicaid or any kind of government assistance or long-term care before they start looking at your assets. So now it's weighing the pros and cons. Which one is better? Is it better to transfer the assets to the kids so that you're able to qualify for any kind of medical help you can get? Or is it better for you to pay out of pocket for whatever medical care you can get, and then the children get the property at fair market value? That's where sitting down and doing kind of like a one-on-one analysis for each person comes in. All right, Brendan, you have your hand up.
Yes, there's some questions in the chat that people have been posting.
Oh, okay. You know what? Let me take one more and then I'll stop sharing my screen so I can go to the questions. Okay. The next thing is delaying Social Security. If you delayed Social Security, hold on. I'm trying to see where the noise is.
Someone's TV or background noise.
Yeah,
Everybody
muted.
commute.
If you're a co-host, you can actually, Nicole. Let me make you a co-host.
Okay, yeah, I don't have the power.
Yeah. Okay.
Thank you.
You can delay Social Security benefits until age 70. One, it increases your payment substantially. There's other people who also claim their Social Security early, and we also run those numbers. When we ran the number for the person that claimed their Social Security early versus waited, it usually takes 10 to 13 years before you catch up by waiting. So again, what you guys are seeing is that there's a cost benefit analysis of doing either one. If you wait until you're 70, you can collect more. If you collected at 62, the person that collected at 62 versus the person that collected at 70, it usually takes about 13 years for the person that collected at 70 to catch up to the person that collected at 62. You also have to look at income that you have from other sources and to see how much of your Social Security is going to be taxed. We have people that are having to pay almost double in taxes because the minute they have income from other sources, a lot of their Social Security is taxed. That's why you have to do an analysis to see, is it better to wait until you're age 70 to delay collect Social Security then? Is it better to claim it now? Do that analysis and then come up with the best strategy for where you are. All right, let me stop sharing since we've done 3. We have about 5, and let me take the questions. Okay. All right, so let me go from the beginning and look at the questions. Okay, so Lynn is asking, is it the same number for the 401k? Yes, there's the same number for the 401k, but we do have to check. So I'm going to write that down. We do have to check whether or not there needs to be something done by the plan administrators, because this was something that was passed with the Secure Act of 2022. So it just happened like what, 2 years ago, when you could start doing that super catch up. So we need to check whether or not the plan administrators need to
Look down
update
here
the
and see if
agreement
there's
in
no
order
car
to be
coming.
able to claim that.
Come on.
Okay, I'm looking for. Okay, thank you, Nicole, for catching that. Okay, next, what else can one do? What else can one do who maxes out their TSP and also maxes out their IRA? I'm not 50, so not eligible for what you just previously mentioned. Yeah. So the other thing that you can do is just put in money in non-qualified accounts, right? The putting money away in the retirement is kind of like a qualified account, but it doesn't mean that you can't develop and also start putting money in non-qualified accounts. I mean, you'll have to pay taxes when you retire, but it's better that you put that money away. So you don't just have to put money away just in a retirement account. You can put money away regularly, whether it's a stock account, index account, any other kind of funding. Anthony, do you want to comment on that before we move on?
Yes, one of the things that I do is for people who want to do non-qualified, I would open up managed accounts where you can buy stock portfolios, indexes, ETFs, and so forth. And within that vehicle of investing, you have better tax advantages. You can have various tax strategies, and not only that, but if you were to sell any of the portfolio, your capital gains will be less if it's more than a year of holding. With a mutual fund, which is a retail account, a regular mutual fund, every year you would have to deal with capital gains and dividends, like the 1099 divs and so forth. So that's one way you can actually save through a managed accounts or even a stock portfolio at a brokerage company.
Thank you. I also see we have another financial planner that is here, Marcella. Marcella, are you in a position to speak, or should we go on? You can type in the chat if you're not available. Okay, let's move on. What about placing the property in a trust? Yes, you can absolutely place the property in a trust, but remember that a trust does not give you asset protection. It only enables you to bypass probate, and it gives you anonymity and privacy, but it is not an asset protecting entity. So that's one important thing to remember, the difference between having properties in LLCs versus having properties in a trust. A trust does not give you protection. If you get sued, the veil will be pierced and it would come to the trustee or the beneficiary owner of the trust. So that's why looking at, first of all, how much equity you have in the property. Do you have any kind of mortgage where there's a first position on it? All of that would help you to determine whether it makes sense to put it in a trust. Now, you can put it in a trust and have an LLC as the beneficiary owner of the trust, right? So that you can also do that, and then also have it as revocable, meaning that as the grantor, you still bear all the burdens and benefits of that property until your passing, and then the children would get it at that time. Okay. What are the risks? Hold on, let me X this out. What are the risks and benefits to refinancing investment property in retirement? Are there tax benefits? Yes, there are definitely tax benefits to refinancing investment properties. One, you're able to get the tax deduction. Two, you're able to get access to the money that you have right now versus later. The only thing is that now you're starting the whole clock all over again, because now you're having to carry a loan. If an emergency happens, tenant moves out, property is destroyed, something happens, and the rent is not coming in, you would have to pay that loan. So that's one of the risks. But the benefit is refinancing enables you to have access to the cash while you're in retirement, using it And of course, if it passes on to the kids, they can, pay off that loan at that time. So again, it's more a matter of security versus access. Do you want access to the money now? Then yes, absolutely, you can refinance. Do you want to minimize the risk of anything happening? If something happens to the property, you might not want to refinance. Okay. Is it prorated if you collect at 69? Yes, there's if you go on the Social Security website, they give you what the amounts are if you collect at 62 or 67 or 70 or 68. It is prorated. So like for example, the amount that you collect at 62 will be lower than 65, will be lower than 68, will be lower than 67. So yes, you can absolutely have it prorated. In reference to delaying Social Security, is there any concern that Social Security will be running out of funds in the future? I can't answer that question. I don't know. We've heard people talk about that there are concerns about Social Security running out. But I would not worry about that, too much. And also is looking at how much you do qualify for Social Security and seeing how does that fit in with the other retirement accounts that you have, so that that's not the only thing that you're relying on for retirement. But I don't know, does anybody have a crystal ball on that? Because I don't know. If I feel like the answer that anybody gives on it sometimes is political, and I like to stay out of that. So I don't know whether or not it's going to run out. Anybody have any comments on that? That is not political.
Well, can I make a comment on that? I
Sure.
just came back from a conference, and one of the things, there was a guy who does his studies for the White House, and he actually is projecting around 2028 that there'll be some changes to Social Security, where it's true that they projected 2035 for the depletion of Social Security to, be impacted. But they're looking at even 2028. And when you really think about it, you look at the fact that how many people do you know, with people being let go from the job, how many people is paying into the Social Security pool? It's becoming less and less, and as a result, there are a lot of challenges that are going to be ahead, and that's why, that particular discussion regarding Social Security was so important to know, because a lot of people believe that it's there forever. And like Miss Ebera said, we need to actually look at other avenues to secure retirement. That means investing now. The plans that she talked about, like the Roth IRAs, maximizing your 401k, taking advantage of even business opportunities to actually create other streams of income is very, very critical, because Social Security alone is not going to cut it. That's all I had to say. Yeah.
Thank you, Anthony. All right, Flo says, I think I want to wait to do Roth conversion for 2 years with less income. Is that correct?
See the
Yes, that is
radio though. My radio, that's the only thing that's died on me.
Hello? Okay. Yes, you want to do your Roth conversions in the years that you have less income. And Flo, instead of just answering this question hypothetically, why don't you, when you do your annual business meeting with David, bring that up so that we can run the scenarios. Like, what is your income going to look like in 2027? What is it going to look like in 2028? So that way we're actually speaking factually rather than just guesstimate. If you will have less income in 2 years, yes, you can absolutely do your Roth IRA conversions then. All right, got it, Marcy. Thank you for being on. So Sam missed the part about passing properties to children. Heard about adding them to deed to avoid probate. What's the best way to get the step up? Can you say that again? So the best way to get step up is that the children inherit the property upon your passing, not before. If the children get the property before your passing, your basis passes on to them. So if you bought a property at $100,000 and you transfer the property to your children before you pass, the children's basis would be $100,000, right? But if the property is worth $300,000 upon your passing and the children get the property after you pass, it will be $300,000 that is now their stepped up basis. That means that if they did sell the property at that time, they will not have any capital gains. So it's just to keep that in mind when we're having this discussion about when the children should get the property. Okay, I've heard many in retirement, no job, have more difficult time getting qualified for a loan, even with a good net worth. Yes, that's true, because most of the time they're looking for like stable income and all that stuff. That's why it is important to make sure that these things are being brought up in the meetings, because we do have a loan specialist who focuses on like real estate investors in terms of the loan products that are available out there. But yes, it is true, because what happens is that in retirement, without having a job, now they're looking at, oh, your income is not stable. If your income is not stable, we cannot trust you with this loan. But there's other loan packages that are out there. There's still no doc loans, that are out there. There's still loans that you are able to get. It's just that the interest rate will be higher. But yes, that is something to consider, that trying to get qualified for loans in your retirement years can be difficult. All right, last question before we go finish up as we start rounding up here. If a self-directed IRA was used to invest in real estate partnership or investment property, should it be divested so that money is available for RMD? You have to calculate where the sources of the RMD will come. Again, that comes with an analysis of, that's why we keep asking everybody, make sure that your financial statements are up to date. A listing of all your assets, all your liabilities. So, and then when you are going to be required to start doing the RMD. So usually after 70, you want to start doing that calculation. If in order to meet your RMD requirement, you have to dip into the self-directed IRA, then yes, the real estate that is in the IRA would have to be sold so that you're able to start taking the distribution. Okay. All right. Medicare is paid for through Social Security. So what would happen through Medicare? Exactly. There's a lot of open areas in terms of what's going to happen in the future. I would say that that's, this above my pay grade. Right now I'm dealing with what I have in front of me. I can't fully answer that question on what's going to happen to Social Security or Medicare. But what I do know is make sure that you're planning. So ask yourself, if Social Security went away tomorrow, would you still be okay? If the answer is no, this is why we're doing this call. We're saying meet with us, meet with the financial planners, make sure that you're having this conversation on what would happen. Because sometimes when you're able to hedge the risk, then you're not worried, because why? Whatever happens, you're more than prepared to deal with it. If you're not ready and you're not prepared to deal with it, that's when it could be an issue. Okay. All right, let me share my screen. We have, I think, 2 more to cover. All right. So we talked about planning for healthcare costs. So the 5th thing is also avoiding lifestyle inflation. So what happens in this is when, in your later years is usually when you start having more money available. Like if you're married or you have children or whatever, your assets are growing. You tend to have more money in your later years than you had in your beginning years. So that's when people can increase their spending on like vacations and renovations and lifestyle upgrades and all that. But you want to be very careful about increasing your lifestyle when you can use some of those funds to get ready for retirement. I'm not saying don't have fun. I like to have fun. In fact, I believe that you should be doing both. But don't allow one to take the place of the other. Make sure that, yes, you do have money that you're setting aside for vacation, renovations, fun, retirement parties, birthday parties, all of that, 70th birthday, 60th birthday. Those are all important milestones that are worth celebrating. But it should not be at the cost of you taking care of your tomorrow. So be very careful about increasing your lifestyle once money becomes available. Instead, use that money to catch up and make sure that you plan for your later years. So those are all the five strategies that we look at for retirement. Again, if you've scheduled your business meeting, we will be talking about some of these some more. If you guys have any other questions, I'll address it. Otherwise, I wanted to bring up something that Marcella had covered in her, I think they had a podcast last week. They covered it, and I thought it was a very important topic for everybody to know about. Okay, so in the absence of any other questions, there's a, I think it's a software. Marcella sent me something about it, so I'm going to write it up as an article and send to you guys. But it's called Pontera. And pretty much what Pontera does is, you know how you have all these assets with a financial planner, but then now you have you have a lot of your money in your retirement account at work. And sometimes the financial planners don't really have access in helping you to manage what you have at work. And I believe that the best retirement plan, the best wealth building strategy that you can have is making sure that you have everything that is under one umbrella, everything being looked at. The person is looking at your real estate, they're looking at your gold, looking at your stocks, looking at retirement, 401ks, assets, looking at everything all together rather than piecemeal. I understand that Pontera now offers that flexibility where they are able to see what's going on in your account to be able to help you maximize. I've had clients that when we're looking at the money that they have in their work retirement account, it's growing at a very slow rate, like at 4%, 6%, simply because they did not know how to choose the right mix of funds that they can invest in, because what is a retirement plan at work. But if your financial planner has access to Pontera, they are able to look at what you have at work, compare it to the strategy that they're implementing for you with the assets that they're managing, and to be able to rebalance your portfolio. I'm always constantly on my financial planner. Let's meet. I want to balance my portfolio. I want to rebalance it because I'm always constantly looking. But if they don't even have access to the retirement account that you have at work, that makes it difficult to be able to balance your portfolio. Okay? Let's see. What are my thoughts on target date funds? I must confess, I don't know what target date funds are. So, Brendan, can you tell us a little bit about that? If anybody else knows about it, please feel free to come on and talk about it. But, Brendan, can you tell us what target date funds are?
Sorry, I'm a little bit under the weather, so that's why I'm using the chat. But basically, the target date funds is like your whatever, I guess 40 or whatever, right? It's like it has a projected retirement date. So when you're contributing to your IRA or whatever it may be, it's projected on it invests on a stream of aggressive and what's the other word? Aggressive and non-aggressive.
The moderate
Yeah,
growth.
it invests based on your targeted retirement dates. So I think
Okay.
I have I think mine's is 2045 or something like that. So it invests like as you get closer to your projected retirement date. Now, not saying you have to retire, but it's just based and it'll be a little bit more conservative. But right now it's probably being a little bit aggressive, and it kind of ebbs and flows based on your targeted retirement date. So that's just I that's what I'm set up in. So I was just curious, what your thoughts on that one.
Okay, so I didn't actually know that it had a term, but that's the same thing that I'm doing with my financial planner. So I put a target date that, hey, I want to retire at this age. And for me, there's going to be a time between when I want to retire and when, whether it's Social Security or official retirement age, kicks in. And so we have to think about what do we do within the gap. But yes, the whole idea of the target date fund is the same thing that I'm using, which is between now and when I'm targeting to retire. How aggressive do I need to be? How moderate do I need to be? How conservative do I need to be? What kind of funds do I need to put my assets in? Whether it's in a retirement account that is, qualified accounts, or whether it's non-qualified, I'm just doing a regular investment. It is based on what that goal is when your targeted retirement date is. That's why it's very important to make sure that you're working with a financial planner, because they are able to run that, including, I think there's a term that they have for it, like a Monte Carlo analysis of, based on when it is that you're targeting to retire, how old you are now, how many years do you have to take an aggressive position in terms of the kind of funds that you put your money in. Anthony, do you have anything to say about that?
Yes, the target dated funds, pretty much is a hands off. It's like a one size fit all. And some of the cons about that is your risk tolerance might not be matched exactly. I mean, it's a one size fit all. It's better to actually sit down with someone who is a professional and they can match your profile with your investment style, and then you can select the funds that match your profile. Because think of a target fund like this. I normally look at like you're sailing a ship, but you have no captain. So wherever the wind blows, that's where your money goes. You don't have any risk, deterrence, meaning that if, let's say, you have somebody looking at your money for you, they can actually make adjustments when the market is falling, but with a target date fund, it's like you go up and down in the market wherever it goes, and it may not even match your risk profile. So that's what I have to say. I think selecting your funds and being properly diversified, and have proper asset allocation is more important than having something that is already made for everyone. It's like a cookie cutter type of deal that you get, one size fit all.
All right, thank you, Anthony. So I'm going to go and start answering some of the earlier questions. I think Sonia said that she feels ready for retirement but concerned about taxes. We all need to be concerned about taxes at retirement. I did talk about something last week that I'm going to bring back on the table, that as you are approaching retirement, actually even right now, you do want to evaluate the sources of income that you have to ensure that you have three sources of income at retirement. One is taxable income. Sometimes you can avoid that. You work, you have to pay taxes. You take out Social Security, you got to pay taxes. So taxable income, that's one bucket of income that you have at retirement. But you can also have tax deferred income, which is income that you're not going to pay taxes on for a while. So you also want to make sure that in your portfolio of assets that you also have tax deferred income. Then the third category is also having tax exempt income, ensuring that in your portfolio that you do have assets that are being invested, that when you start taking money out from it, you don't have to pay any taxes. It's a little bit sophisticated, but I do it. Mine is through my IUL. Lower rate of return, but I love the fact that if I have to take money out and start taking money out later, I don't have to pay taxes because already paid the premium. But again, it's sophisticated. You have to work with your financial planner. So if you're concerned about taxes, One, make sure that you're doing an analysis with your financial statements, the kind of assets that you have, but make sure that you have these three kinds of income: taxable income, tax exempt income, and tax deferred income. Okay. Rabbi, since you're getting ready for retirement next year, make sure this comes up in your annual business meeting so we can start looking at your financial statements, your assets, everything that you have to make sure that you are ready. Okay. Okay, Nancy has already left, but she is building small business. You can absolutely plan for retirement by building up your small business. Okay. Can you give an example of tax deferred income? So it's the money that you have in your 401k. Remember that if you have income from your regular job or you have money from the stock account, you don't have to pay tax. You don't have to pay any income on the money in your 401k until you start taking it out. So that means that it very well could be in your later years, like after you turn 70 or when you start getting into RMD, between 62 and 70, you can be using other types of income, the income that is taxable. So that's example of a tax deferred account, or the Roth, traditional, anything that is IRA related, that you, when you take it out in later years, that's when you pay the taxes. Tax exempt is when you pay the taxes now, or you pay taxes, you get it like the IUL. A lot of people don't like to use IUL, but let me tell you what I did with the IUL. I have the IUL where I'm paying a lot into the IUL right now, because if anything happens to me, the kids are able to get that policy. But at a certain time, if I get into an emergency, I am able to take money out of the IUL and it's tax exempt. So that's when you look at the cash surrender value of your life insurance policy, where you're able to take that money out. So the strategy is making sure that whatever that you put into the IUL, that you're not just putting money away for if anything happens, the kids get the policy, but you also have something extra where you're able to take that money out and you're not having to pay taxes on it. So what I'm going to do, I'm going to write that down and do an article on that so that I can give you guys practical examples of the three buckets of income. All right, let's see. Oh, I'm sorry. It's an index universal life insurance. So it's kind of like a life insurance that kind of mirrors what is going on in the stock market. It's more expensive to set up, but it also helps you build cash surrender value faster than if you were to do like a term or a whole life policy. Okay, so index universal life, that's what an IUL is. So I'll also send you guys an article about that. All right, we have about 5 minutes to go. Does anybody have any last minute questions? Anything that I did not cover about retirement that you think is worth covering or that you need to ask about? For those of you that were not on last week, so we did talk about the gold ETFs and the AI ETFs. So my son, the 18-year-old, yes, he got to come to work, has started doing research on the gold ETFs and the AI ETFs. And we've identified about 7. So Regina, I'm going to send that to you because I know you were also looking. And what I found out is that all 7 ETFs that we looked at for the gold and the AI, between 2021 and 2025, their values have more than doubled. Like it's gone on significantly. So it's something that is worth looking into. I'm going to be investing in it. For those of you that are Christians, I invested in a Bible stock, BIBL stock, and it's increased actually 71% from the time that I got it 2 years ago. So if you're a Christian and you want to do like faith-driven investing or faith-driven entrepreneurship where you're supporting stuff that is about our causes, look at the BIBL stock. This is in addition to all the other stable, safe investments that you already do. Okay? Can we get a replay of session 1? Unfortunately not. Don't ask me what happened. I believe that you guys were here last week when I said, is this call being recorded? And we saw that it was being recorded, but when I got off, it was not there. So we've been trying to get with Zoom to find out, what happened and why we lost that. So, but we did, the good thing was that we did have the transcript. So we are gonna do the recording again based off of the transcript and then send it out along with today's recording. So I did make sure that today I pressed the recording. Hopefully it's nothing else, but we do have the transcripts available. So let me give you guys the stock symbol for the Bible stock. Right here. Okay. Okay. Any strategy on how to withdraw from 401k to invest in Roth IRA and save on taxes? Well, a 401k and a Roth are both qualified accounts. So unless you're saying that you're going from a 401k or traditional into a Roth, but if you're going to go from a 401k to a Roth, is what I was talking about earlier, Shalita, about doing a Roth IRA conversion, right? So you're converting from the 401k into a Roth. So yes, you can do that. And the strategy, like I said, is looking at your taxable income, your AGI, to see what year is the best year for you to do that conversion and minimize the upfront taxes that you have to pay, right? So an analysis needs to be done based off of where your AGI is, how much taxes you're going to pay, and then when you do invest in the Roth, what kind of return are you going to get, and when are you going to take out the money? Doing all that together, yes, you are able to implement a strategy where you can move money from a 401k or traditional into the Roth account. Okay. All right, we literally are 1 minute away. So thank you guys. Oh, I think I told you guys this, but I'll be sending out the announcement. For those of you that watch Tyler Perry's shows, he has a show called Beauty in Black. The main cast there, his name is Rico Ross, that plays Horace in Beauty in Black. My daughter is going to be a co-panelist with him on June 27th, where they're going to be talking about wealth strategies. So yay, I'm excited about that. So we will be sending you guys information for that. They are targeting young adults, and I am going to be making 10 tickets available. The tickets cost $100 each, but I am very interested in making sure that our kids participate. So if you do have young adult kids that you want to attend the event, please feel free to reach out. We are going to be making 10 tickets available to them. It's June 27th. It's going to be on National Harbor at 1 p.m. So when I do send out the announcement, if you have young adult kids that you want to attend, we will be making 10 tickets available because we do want them to be there. It's going to be a very powerful time. Yes, it's going to be, it's in Baltimore. So regionally, I know that you guys are in New York, but I know Anne-Marie, she's usually very adventurous. If she wants to drive down to Baltimore on June 27th, 1 p.m., I absolutely will have a free ticket for her if she wants to come out. All right, I think we have come to the end of our meeting. Let me stop the recording.